Hey guys, this is Vyom Joshi with Superior North. Welcome back to my channel. Today we will be talking about Citigroup. Now, it's important to understand that banking is highly complex and it's hard to find the intrinsic value of a specific bank, especially when it's one of the top 10 banks in the United States. Banking inherently is highly complex and we don't necessarily know how one part of the business is correlated and would affect the other part of the business. Just to give an example, back in the 2007-2008 financial crisis, banks were coming out with these mortgage-backed securities that got a credit rating from the credit agencies. So if the security had a AAA rating on its bond, over time, if that mortgage-backed security deteriorated such that it was only a double B or a single B bond, there was no re-rating of those bonds. So the banks that held these securities at book value never deteriorated those bonds or impaired those assets, which is one of the reasons why book value can be said that it's not really the best metric to go after when finding the intrinsic value of a bank. Additionally, banks had to hold reserves based on those bond ratings. So if the company thought that it had a AAA rated bond, it only had to hold a tiny amount of reserves in cash, whereas if it held a junk bond, it had to hold a high reserve of cash on hand. And that is one of the reasons why there was a liquidity crunch back in 2007-2008 with all the banks. So with that in mind, let's look at the fundamentals of Citigroup and try to find the intrinsic value of this company.
Hey guys, I'm on QuickFS looking at Citigroup Inc. We can see that the company's current market cap is about $94 billion. Looking at the business description, Citigroup Inc. is a diversified financial services holding company which provides various financial products and services to consumers, corporations, governments, and institutions in North America, Latin America, Asia, Europe, the Middle East, and Africa. Citigroup operates through three segments: Institutional Clients Groups, ICG, which brought in about 55% of the company's 2022 revenue. Second is the Personal Banking and Wealth Management Group, which brought in about 32% of the company's 2022 revenue. And finally, the Legacy Franchises, which brought in about 11% of the company's revenue. By the time we look at the net income numbers for these three segments, we can see that Legacy Group is losing money, and Citigroup is in the works of divesting some of its Legacy Franchises assets. Next, looking at the key statistics, we can see that Citigroup's PE ratio is at 6.2. This implies an earnings yield of about 16.12%. The company's price to book is at 0.4. Price to sales is at 1.2. The 10-year median return on equity is about 7.1%. Now let's look at the company's net interest income. In 2013, the company's net interest income was about $47 billion. And for the year 2022, it's about $49 billion. Over the past 10 years, the company's net interest income has stayed fairly consistent. Next, looking at the net interest margin. This number is calculated by looking at the company's interest received minus interest paid divided by its average assets. Back in 2013, the company's net interest margin was 3.5%, and for the year 2022, it's 2.9%. JP Morgan Chase, which is considered one of the gold standards amongst US banks, has a net interest margin of about 2.4%. The industry average is about 3% for the first quarter of 2023. Next is the return on assets. The return on assets is calculated by looking at the company's net income divided by its total assets. Back in 2013, the company's return on asset was about 0.7%, and for the year 2022, it's about 0.6%. Over the past 10 years, the company's return on assets, for the most part, except the year 2017, has been positive. JP Morgan's 2022 return on asset is 1%, and Bank of America's return on asset is about 0.9%. Next is return on equity. This is simply the ratio of net income divided by shareholders' equity. So as shareholders, this gives us an idea of what kind of return can we expect to get on our equity. Back in 2013, the company's return on equity was about 7%, and for the year 2022, it's about 7.3%. JP Morgan's return on equity for the year 2022 is 12.8%, and Bank of America's 2022 return on equity is about 10.1%. Now let's look at the company's asset to equity ratio. This, as the name suggests, is the ratio of the company's total assets divided by its shareholders' equity. Ideally, we want the company's asset to equity ratio to be a small number. The smaller, the better. Back in 2013, the company's asset to equity was at 9.1, and for the year 2022, it's at 12.0. We can see that the company's asset to equity ratio has been trending up. This tells us that the company is taking on more liabilities. In other words, it is becoming more leveraged. For banks, the required minimum equity to asset ratio is 5%. And for Citigroup, that means it's 1 divided by 12, which is 8.3%. In other words, the maximum asset to equity ratio that the banks are allowed to have is at 20. and Citigroup's 12 is certainly less than that 20. JP Morgan's asset to equity ratio is about 12.5, and Bank of America's asset to equity ratio is at 11.1. So we can see that Citigroup's asset to equity ratio is around the same as the other major US banks. Now let's look at some of the key ratios for Citigroup. The first one we have here is the loan to deposit ratio. This ratio gives us an idea of what percentage of the company's deposit does it loan out. Back in 2013, Citigroup loaned out about 68.5% of all its deposits, and for the year 2022, it's about 48.1%. We can see that Citigroup is being more conservative with its deposits now than it was 10 years ago. JP Morgan's loan to deposit ratio for the year 2022 is 48.5, and Bank of America's loan to deposit ratio for the year 2022 is 53.8%. Next is the loan loss reserves to loan ratio. This ratio gives an idea of how much money does a bank have set aside in case of an economic downturn. So the higher the number, the better the bank will be in an economic downturn. Citigroup's 2022 loan loss reserve to loans ratio is at 2.6%. This is lower than the loan loss reserves to loan ratio of 3.7% in 2020 during the pandemic. However, it's higher than the pre-pandemic levels of 1.8%. JP Morgan's loan loss reserves to loans ratio is at 1.7%, and Bank of America's loan loss reserves to loans ratio is at 1.2%. So in that regard, Citigroup is being more conservative than its peers. We already talked about the net interest margin and leverage. We already talked about the asset to equity ratio. We also talked about Citigroup's return on equity and return on assets. And talking about returns, it's also one of the reasons why Citigroup tends to trade below the book value. If we compare these returns to those of JP Morgan Chase, we can see that the returns are much better and much higher than those of Citigroup. And at the same time, JP Morgan has about the same leverage as that of Citigroup. So clearly we can see that since Citigroup's returns are lower with the same amount of leverage, it also trades at a lower multiple than that of its peer, JP Morgan. Now let's look at the per share values for revenue. Back in 2013, the company's revenue was about $25.6 per share. And for the year 2022, it's about $38.34 per share. And since we're talking about per share values, it's important to note that the company has been buying back its shares ever since 2013. Back in 2013, the company had about 3 billion shares outstanding. And in the year 2022, it had about 1.9 billion shares outstanding. So over the past 10 years, the company bought back about 1.1 billion shares. Next, looking at the book value, the company's book value back in 2013 was $65 per share. And for the year 2022, it's about $93 per share. Focusing on the tangible book value, this is similar to book value, except it's tangible, so it's physical assets. Back in 2013, the company's tangible book value was $55 per share, and for the year 2022, it's about $81 per share. We can see that all the per share numbers from earnings, income, book value, and tangible book value have been trending upwards over the past 10 years. Those are certainly trends we want to see in a company. Now let's try to find the intrinsic value of Citigroup. For that, I will go to the company's income statement and focus on the net income number for the year 2022, which is about $14.8 billion. And I will not be using an Excel sheet because I just want a rough estimate of whether or not the company is trading far above or far below the intrinsic value. And to get a conservative estimate of the intrinsic value, I will be using the no growth perpetuity formula. And since this is a bank, I'd rather look at the company's net income number rather than its free cash flow. If we use Citigroup's net income number of $14.8 billion and use a 10% discount rate, and this 10% is 5% above the company's weighted average cost of capital. Another way you can think about this is it's about 6% on top of the 4% 30-year US Treasury yield. So you can think about the 10% discount rate as 5% weighted average cost of capital plus 5% of my margin of safety, or 4% of US 30-year Treasury yield plus 6% of my margin of safety. It's just arbitrary. Pretty much you can pick whatever discount rate you're comfortable with. Just know that the smaller the discount rate you pick, the larger intrinsic value you will be getting. So in order to be conservative, it's better that you pick a higher discount rate than a lower discount rate. With that in mind, if we divide $14.8 billion by 10%, we get about $148 billion. Citigroup's market cap right now is about $94 billion. So we can clearly see that $90 billion is a lot less than $148 billion, implying that Citigroup is undervalued at the current stock price. Hey guys, that is all I had for you this week. Hopefully you found this video on Citigroup interesting. If you like this content, please do like, share, comment, and subscribe. And if you have any suggestions on which stock I should review next, please leave it in the comment section below. I'll greatly appreciate it. Thank you.